This is my year-to-date returns for one of my investing accounts for 2024. And for context, the S&P 500 has returned this much, thus outperforming the market by this. And no, this video isn't a get-rich-quick formula or the next crazy meme coin that you should be buying. The results that I showed you earlier is all from applying simple but yet realistic investing strategies that anybody, including yourself, can use. I'm Eric Pan, aka Ericnomics, and I make investing easy to understand for beginners, and I like to share the latest market updates and any profitable investing ideas backed by research. In this video, I'm going to be breaking down 3 actionable investing strategies that are suitable for beginners, part-time investors, or seasoned pros. With the right investing mindset, these 3 strategies can help you start building wealth step by step. You're going to be learning number 1, dollar cost averaging into long-term bullish assets. This is best for part-time and passive investors. Number 2, my growth investing strategy, using a detailed research framework to find event-driven growth stocks. And number 3, diversification and concentration, diversifying strategically and having a higher concentration on conviction plays. If you're ready to take investing seriously into the new year, please drop a like and subscribe. It takes less than 1 second and doesn't cost you a single cent. And make sure to ask any questions in the comments regarding the strategies, or if you simply want to share your thoughts. If you're ready, let's go. The first investing strategy that I recommend for beginners is the easiest strategy of them all, and it's to dollar cost average. More specifically, focusing on long-term bullish assets. If you're new to investing, the dollar cost average, or DCA for short, is by far the most realistic and beginner-friendly strategy out there. If you already have some experience, you know that this is the most passive yet one of the most profitable investing strategies if you have the right asset. Here's how DCA works. Instead of trying to guess the market or figuring out when the price is at its lowest, you invest a fixed amount of money at a regular interval. For example, $100 every week, no matter what the market is doing. It could be up, it could be down, it doesn't matter. Just $100 every week, period. This averages out your cost basis and takes out all the stress out of timing the market. And this strategy is especially powerful when you pair it up with long-term bullish assets. In other words, you want to focus on assets that are designed to grow steadily over time. Why? Because history shows us that time in the market beats timing the market. The longer you stay invested in quality assets, the more likely you are to see positive returns. Let me emphasize how important it is to stay invested. JP Morgan studied the S&P 500's performance spanning 20 years from 2004 to 2024. If you stayed fully invested, you would have returned about 9.8% per year. Now, here's where it gets interesting. If you simply miss 10 of the best performing days out of the entire 20 years, your returns drop from 9.8% down to 5.6%, almost half. And if you miss 20 of the best trading days out of the entire 20 years, your annualized returns are 2.9%. Lastly, if you miss 30 of the best trading days, your returns are less than 1% per year. What's even crazier is that 7 out of the 10 best trading days occurred during bear market territory. So I could assure you that most people won't have the grit to buy when the market is in free fall and everyone is panicking. And the beauty of dollar cost averaging is that it works for everybody, no matter how experienced you are. It's consistent, stress-free, it removes the emotion out of investing, and one of the best passive income strategies out there. You don't need to be staring at charts all day or guess when the market will crash. You just set up your recurring investments and let the magic of compound interest do the rest. Now, if you're new to the financial markets, let me give you an example of long-term bullish instruments that are actually available for regular retail investors like you and me. I personally DCA into 2 of my favorite ETFs, VOO, which tracks the S&P 500, and QQQ, which tracks the NASDAQ 100. These 2 ETFs are the most commonly known long-term bullish assets because they represent the biggest and best performing companies in the world. And over the past few decades, these ETFs have delivered consistent returns despite short-term volatility. Now, if you're wondering, Eric, what is even an ETF? Don't worry, let me keep it simple for you. An ETF, or exchange traded fund, is simply a basket of stocks that you could buy into. Instead of buying individual companies, you get exposure to a whole group of them. Think of it like buying those variety candy boxes where you get a bunch of different snacks when you buy the whole candy box. VOO and QQQ are just simply two examples, and there are ETFs of all kinds of things. There are sector ETFs such as XLV for healthcare, XLE for energy, or XLF for financials. These are great for investing into an entire sector rather than picking specific individual stocks. Now, there's also global market ETFs such as Vanguard's Total Market ETF, VTI, which are great for diversifying into a broader range of economies. And then you have the high dividend ETFs such as the Schwab US Dividend Equities ETF, SCHD, specifically offering high yields of dividends for investors. Now, if you're interested in learning about some of my top ETF choices, comment ETF down below. I want to make sure that I'm making content that is actually providing you guys with actionable tips. So we've just covered the dollar cost averaging strategy that is perfect for part-time investors who want to build wealth steadily without all the noise. Now, if you're just like me, willing to take on more risk to chase higher returns, let me move on to the next strategy, growth investing strategy. Growth investing isn't about picking the highest potential company, but rather identifying growth opportunities based on events and catalysts that can significantly impact the company's stock price. For example, earnings reports, product launches, or even industry shifts. These events can create short-term price movements that smart investors can take advantage of. But here is where it gets really important. It's not about blindly following the news. You need to dive deep into the numbers, do your due diligence, and find stocks with solid fundamentals that have high potential for growth. So here's a 3-step framework on how I research growth investing opportunities. Number 1, study the fundamentals. Look at the company's financial health, including revenue growth, profit margins, cash flows. You want to find companies that are not just surviving, but thriving. Number 2, analyze the catalyst. Is there an upcoming event that could drive the stock price up? Is there anything from new product announcements to better than expected earnings? Number 3, evaluate the market sentiment. I like referring to the analyst ratings, price targets, recent news, and sometimes even social media. Sometimes the market's mood can tell you a lot about the short-term price movements. So feel free to take a screenshot of this 3-step framework listed here for you and use it as your investing research cheat sheet. And if you found this helpful, please give this video a like. So why does event-driven growth investing work? Because the financial markets are driven by information. By doing your research and staying ahead of the curve, you can identify opportunities before the rest of the market catches up. Combine that with discipline in your risk management and patience, and you will gradually master growth investing. In my Financial Framework private Discord community, I share all the stocks that I'm watching and how I identified CrowdStrike stock when the price of the stock was under $300 and how I let it run to my price target of $330. I was trading this stock since 2020, but it resurfaced on my radar when the whole IT outage occurred over the summer, causing one of the world's largest IT outages in history, causing a 42% drop over the span of 2 weeks. And to me, this was completely disconnected from what it was truly trading at, considering the company's fundamentals. Prior to the outage, the total market cap of the company was about $91 billion, and it fell as low as $53 billion. But nothing about the company's fundamentals has changed. Sure, there will be a lot of angry customers potentially leaving, which will hurt its revenues or even a lawsuit. In fact, Delta Airlines is launching a $500 million lawsuit against them, which is significant. However, the results won't materialize for a very long time. Its revenues are consistently increasing quarter over quarter and even hitting profitability last year, heading in the right direction. They're also bringing in more than $3 billion in annual recurring revenue, and a majority of their customers are using multiple products, which is extremely impressive. In addition to that, their balance sheet is extremely strong with an increasing cash pile while keeping their debt stable. Lastly, their operating and free cash flows are looking pretty healthy, and I'd say their valuations are a little bit expensive, but it's common amongst high growth companies. So with it still being a fundamentally strong company, it didn't justify essentially being almost worth half of what it was overnight and signaled to me that this was a market overreaction. But this is really important. These are not buy signals. My goal isn't to tell you what to buy, but rather show you how I approach the research investing process. Every investor has different risk tolerances, their goals, and whatever, and it's crucial to build a strategy that works for you. And the key is to have a framework that helps you identify high probability opportunities while managing the risk. Growth investing is about being selective and disciplined and not chasing every shiny stock that comes your way. So let's use CrowdStrike as an example. The risk for the trade was planned before executing the buy order. And as you could see in the chat history, this was a baby-sized trade. I only took a total of about 4 shares. Why? If I was wrong about the play, I was prepared to close out the trade as soon as I was down about 15%. Now, if you're serious about growth investing and want to develop your own process, a very simple yet crucial tip is for you to start small. Start small. I recommend allocating a maximum of 50% of your entire portfolio for this strategy if you're new. You shouldn't be thinking of hitting those home runs immediately, but rather instead, you want to be practicing with a small amount of capital that you're comfortable with. Develop a reputable process on how you identify a stock, research the catalyst, assess your potential risk to reward, and slowly master your craft. And if you'd like me to make an in-depth tutorial on how I research growth investing opportunities, let me know in the comments down below. Diversification and concentration. The third investing strategy is diversification and concentration. You've probably heard this saying before. Don't put all your eggs in one basket. It's simple, but yet a powerful principle. Diversification is all about spreading your risk, and when you have a diversified portfolio, you're essentially building a safety net. If one stock takes a nosedive, it won't drag your entire portfolio down. Now, diversification can take many forms. It's not about just owning a bunch of different stocks. You can diversify across geographies, which means investing in companies from different countries or regions. This helps you mitigate risk if one particular country's economy is taking a hit. You could also diversify across different asset classes like stocks, bonds, real estate, commodities, or even alternative assets like crypto or private equity. Each asset class behaves differently, so when one zigs, the other one might zag. Then there's market capitalization. You want exposure to small caps, mid caps, large cap companies. Small cap stocks might have more growth potential, but might be a little bit more riskier, while large cap companies might tend to be a little bit more stable with slower growth. Sectors are another big one. Think of various sectors out there: tech, healthcare, energy, consumer goods, financials, so on. If you're all in on tech and there's a major downturn in that sector, your portfolio could be taking a huge hit. But if you're diversified into other sectors, that might balance things out. And the idea here is to reduce the impact of a single failure while capturing the overall market growth. And it's about balance. But, and this is a huge but, there's another side to this coin: concentration. While diversification helps you manage your risk, it sometimes can dilute your returns. And that's why I also believe in having a higher concentration in positions that I believe I have a strong conviction about. Let's just say you've done your due diligence. You've researched the stock, analyzed the company's financials, evaluated its leadership, and you have a clear understanding of its competitive advantage. Maybe it's a disruptive tech company or a well-managed business in a growing industry. You've crunched the numbers and everything checks out. This is where concentration comes in. Instead of spreading your investments too thin, you make a strategic bet putting more capital into that stock. And the goal here is to achieve outsized returns on positions that you believe in the most. Think of it like this. If you invest into 30 different stocks with all equal weight, even if one of them doubles in value, it won't have a huge impact on your overall portfolio. But if you've concentrated more of your positions into winning stocks, your overall returns will see much bigger boost. Now, it doesn't mean that you should be YOLOing into a handful of stocks. Concentration should always be grounded in research and discipline. It's not about chasing hype or getting emotionally attached to a stock. It's about making an informed decision and sticking to your investment thesis. Sometimes identifying stocks with high conviction takes time and patience. While you're waiting for the right opportunities, it's important that your money isn't just sitting around doing absolutely nothing. And that's where Moomoo comes in. They're offering an impressive 4.35% on idle cash with a bonus of 3.75 for 3 months, bringing your total yield to 8.1% APY on idle cash, meaning your money continues to work for you even when you're not actively investing. Now, it's a great way to maximize your returns while staying ready to pounce on those high conviction investments when the time is right. You can get this by signing up using the link in the description down below. Now, in summary, diversification and concentration are two sides of the same coin. Diversification protects you from downside, while concentration allows you to capitalize on your strongest convictions. The key is to find the right balance that works for your risk tolerance and investing goals. Diversification protects wealth, while concentration builds wealth. All right, those are the top 3 investing strategies for 2025. Dollar cost averaging into long-term bullish assets, growth investing using event-driven growth stocks, and diversification and concentration. Whether you're a complete beginner or already have some experience, I hope that these strategies can help you rebalance your portfolio into the new year and improve your portfolio's performance. If you found this video helpful, please give it a like and share it with someone who's ready to start investing seriously. Now, you could also watch this video over here where I explain the 5 things that you must know if you're interested in Bitcoin investing.